There's a pattern that shows up before every collapse, and right now we're watching it unfold again. Back in 1929, the smartest people in finance were saying the danger had passed. The market had reached what they called a permanently high plateau. Just weeks later, everything started cracking. Within months, the whole thing came down. What happened next wasn't just a market correction. It was a 10-year unraveling that changed the entire world. The warning signs were there in 1929, and they're here now. The illusion of stability during the summer and fall of 1929. There was this overwhelming sense of confidence across Wall Street. It had hardened into absolute certainty. Everyone seemed to agree the American economy had entered a new era. The old rules just didn't apply anymore. The Dow had been climbing for 8 straight years. Stock prices were up 6 times from where they'd been in 1921. By September 1929, the index hit 381 points. That wasn't just growth, it felt like transformation. In less than a decade, the market had gone up tenfold. This wasn't speculation, people told themselves. This was progress. Banks were lending aggressively. Credit was flowing freely to investors buying stocks on margin, putting down only 10 to 25% of their own money. The brokerage firms covered the rest, sometimes 75 to 90% of the purchase price. There were about 600,000 margin accounts across the country, and as long as prices kept going up, everything seemed fine. The Federal Reserve actually tried to step in. In March of 1929, there was a small correction after the Fed warned about excessive speculation. Banking interests reacted fast. National City Bank pledged $25 million to stabilize things. The whole disruption lasted about 48 hours. By summer, prices were climbing again. They kept rising, almost without interruption, until early September. Irving Fisher watched all this unfold. He was one of the most respected economists in America, a scholar whose ideas about monetary policy would shape central banking for generations. On October 15th, just days before everything fell apart, he made a public statement. Stock prices had reached what looked like a permanently high plateau, he said. He expected the market to go considerably higher in the coming months. Fisher wasn't some reckless speculator. He was a serious academic doing serious analysis. Corporate earnings looked strong. Industrial production was robust. Every technical indicator pointed to continued growth. What Fisher and everyone else missed wasn't in the economic data. It was in the structure underneath it all. The system looked stable because everyone believed it was stable. That belief created the appearance of stability, which made people believe even more. The cycle kept feeding itself until something came along to test whether the stability was real or just psychological. Historical case study number 1. The American collapse of 1929. The first break came suddenly, but it didn't seem catastrophic at first. On October 23rd, during afternoon trading, prices started falling for no clear reason. Some blamed discussions about tariff legislation. Others figured it was just profit-taking after such a long bull run. Then came October 24th, Black Thursday. The market opened with violent selling. Within hours, 13% of the market's value had evaporated. The big financial institutions held emergency meetings. Major banks pooled their money and started buying stocks above market price, the same tactic that had worked during the panic of 1907. It brought temporary calm. That calm lasted for days. On Monday, October 28th, the Dow dropped nearly 13%. The next day, Tuesday the 29th, another 12% disappeared. In just 2 days, a quarter of the market's value was gone. By mid-November, half the market had been wiped out, and it kept falling, month after month, year after year. The bottom finally came in the summer of 1932. The Dow had crashed to 41 points. From top to bottom, 89% of the market's value had been destroyed. If you'd invested $1 at the September 1929 peak, you'd have about 10 cents left. The index wouldn't get back to that 1929 level until November 1954, 25 years later. But here's the thing, these market losses, as dramatic as they were, didn't directly cause the broader economic disaster that followed. Only about 10% of American households even owned stocks. The connection between Wall Street and Main Street ran through more subtle channels. Confidence was the first thing to go. People who'd watched their savings disappear stopped spending. Even people who hadn't lost money in the market started saving more, worried about what was coming. Big purchases, especially things bought on credit like cars, dropped off sharply. Manufacturers cut production. Workers got laid off. Unemployment climbed, and then the banking system started coming apart. Most banks had money in the stock market either directly or through loans to investors. When stock values collapsed, those assets became worthless. When depositors tried to withdraw their money, banks didn't have enough reserves. By the time things bottomed out, around 4,000 banks had failed. Deposits vanished. Local credit markets just seized up completely. The agricultural sector, which was already struggling with overproduction and falling crop prices, couldn't service its debts. Farmers lost their land. Rural banks collapsed. The crisis spread from the cities into the countryside. Industrial production in 1933 had fallen to 54% of where it had been in 1913. The economy had just contracted it, had gone backwards by a decade. Unemployment hit 25%. What started as a market correction had turned into a civilizational crisis, but this pattern, it wasn't new. Historical case study number 2, Weimar Germany's monetary dissolution 7 years before the American stock market peaked. Germany went through a different kind of financial catastrophe. The Weimar hyperinflation of 1922 and 1923 shows just how fast confidence in a monetary system can evaporate once people start questioning the fundamentals. Germany came out of World War I drowning in debt. The government had financed the war through borrowing instead of raising taxes, racking up 156 billion marks by 1918. Then the Treaty of Versailles piled on another 50 billion marks in reparations to be paid in gold or foreign currency. The government had a choice: raise taxes dramatically and risk riots in the streets, or print money. They chose to print it first. The inflation crept along gradually. The exchange rate went from 4 marks per dollar before the war to 69 marks per dollar by late 1920. The government convinced itself this was manageable, temporary, just an accommodation to extraordinary circumstances. Then in January 1923, France and Belgium occupied the Ruhr industrial region, demanding that German industry pay reparations directly. The German government ordered a general strike, and they subsidized those striking workers by printing even more money. The hyperinflation phase kicked off in July 1922. Prices had already jumped 700%, but that was just the beginning. Between August and September, the cost of living rose another 71%. By November 1923, $1 American could buy 4.2 trillion marks. The social consequences were immediate and brutal. Workers would get paid in the morning, and by evening their wages couldn't buy bread. Restaurants changed their prices while customers were eating. Shopkeepers couldn't restock fast enough to keep up with rising prices. Farmers refused to sell crops for currency they knew would be worthless within hours. People from the cities started organizing raids into rural areas to steal food. The middle-class families that had built up savings over generations watched everything disappear overnight. A lifetime of careful financial planning, gone in weeks. Pensions that were supposed to support retirees couldn't buy a single meal. The psychological damage from this wealth destruction would echo through German society for decades. Meanwhile, people with debt made out like bandits. Mortgages taken out just months earlier could suddenly be paid off with nearly worthless currency. Businesses that had borrowed heavily found their obligations effectively eliminated. The system was literally rewarding recklessness and punishing prudence. They finally stopped the hyperinflation by introducing a new currency backed by land instead of government promises. The Rentenmark went into circulation in November 1923, and they stopped printing the old marks. The crisis ended almost overnight, but the damage to society was done. The economic chaos fed directly into political radicalization. The destruction of middle-class wealth created conditions where extremist ideologies could take hold. Within a decade, the political fallout from the hyperinflation would reshape not just Germany but the entire world. At first glance, the connection between the American stock crash and German hyperinflation isn't obvious. One was about collapsing asset prices, the other about currency debasement, but underneath, they followed similar mechanics. Transition to the present. Today's global financial system operates under different rules than what existed in 1929 or 1923. Central banks coordinate internationally now. We have deposit insurance to prevent the bank runs that destroyed 4,000 American institutions. Financial regulations impose capital requirements and stress tests on major banks. These structures were specifically designed to prevent history from repeating, but the fundamental dynamic that comes before financial instability, that hasn't changed. Debt has reached levels we've never seen in peacetime. In 2024, global debt topped $323 trillion, approaching 240% of world GDP. Public sector debt alone passed $99 trillion. Corporate debt hit $35 trillion. Household debt exceeded $54 trillion. For context, total American debt relative to GDP in 1929 was substantially lower than what we're seeing today, and it took a full decade to work through the consequences of that debt burden. Here's what's concerning: current borrowing hasn't been funding productive investment. Since 2008, corporate bond issuance has exceeded the pre-crisis trend by nearly $13 trillion. But corporate investment has stayed $8 trillion below trend. So where's all that borrowed money going? Share buybacks, dividend payments, refinancing existing debts. This creates a specific vulnerability. If the debt piled up over the past 15 years isn't generating returns through productive activity, it has to be serviced either through more borrowing or by selling off assets. Either way leads to the same place. It's just a question of timing. The global financial system is showing conditions that historically come before major dislocations. Interest rates were effectively zero after 2008, but they've risen significantly since. Central banks bought massive quantities of government bonds during the pandemic. Now they're reselling them back into the market. The proportion of sovereign debt held by central banks in advanced economies dropped from 29% in 2021 to 19% in 2024. What this means is that price-sensitive investors, mainly households and foreign entities, have to absorb more bonds at market rates. If these investors start demanding higher yields to compensate for risk, borrowing costs go up for governments and corporations at the same time. And here is the problem. 42% of sovereign debt and 38% of corporate bonds mature within the next 3 years. The refinancing requirements are substantial. The parallels to 1929 aren't perfect. Historical analogies never are. But the pattern recognition is unavoidable. Credit expansion, followed by asset price inflation, followed by a shift in sentiment that starts questioning whether the whole structure is sustainable. This sequence has shown up before every major financial crisis over the past 4 centuries. The pattern recognition section: financial systems fail according to stages you can recognize. These stages appear across different time periods, different countries, different monetary systems. The specific details change, but the underlying sequence stays remarkably consistent. Stage 1 is real economic expansion. Production increases, living standards improve, new technologies or markets generate legitimate wealth. This phase sets up everything that follows. Stage 2 brings credit expansion to finance continued growth. Initially, this credit flows toward productive investment loans for building factories, developing infrastructure, starting businesses. The borrowed capital generates enough returns to service the debt. Stage 3 is where credit expansion starts outpacing productive investment. Money flows toward speculation instead of production. Asset prices begin rising faster than the underlying assets can actually generate income. Debt piles up faster than the economy can service it through real output. This third stage creates a particular mindset among market participants. Prices have been going up, so recent buyers have made money. This reinforces the behavior. More people jump in, often using borrowed money, expecting to replicate earlier gains. Eventually you run out of new buyers. Stage 4 hits when the math becomes unavoidable. There aren't enough new buyers to absorb assets at current prices. Small declines start. These trigger margin calls for leveraged investors. Forced selling pushes prices lower. That creates more margin calls. The cycle feeds on itself. Stage 5 is the confidence collapse. Market participants suddenly realize the whole structure was dependent on continuous price increases. Once prices stabilize or fall, the system becomes unsustainable. What everyone thought was safe investment is suddenly recognized as speculation. Panic selling kicks in. Stage 6 is when the contagion spreads beyond financial markets into the real economy. Banks that lent against inflated asset values start taking losses. Some fail. Credit markets freeze. Businesses can't get operating capital. People lose jobs, consumer spending contracts. The feedback loops multiply. Stage 7 is the long, grinding recovery. Asset prices stabilize far below their peaks. Banks rebuild capital. Debts get restructured or defaulted on. The economy slowly rebuilds productive capacity. This phase typically takes years or even decades, depending on how severe the initial imbalance was. This pattern showed up in the Dutch tulip mania of 1637. It was there in the South Sea bubble of 1720, in the Mississippi bubble in France that same year, the British banking crisis of 1772, the American panics of 1819, 1837, 1857, 1873, 1893, and 1907. In 1929, the Latin American debt crisis of the 1980s, Japan's asset bubble in the 1990s, the Asian financial crisis in 1997 and in 2008. Each time the crisis got blamed on specific contemporary factors. Tulip mania was irrational speculation in flowers. The South Sea crisis was corrupt dealings between the company and government. The 1929 crash was inadequate regulation of margin lending. 2008 was subprime mortgages and complex derivatives. These specific factors were real, but they were symptoms of the underlying pattern, not root causes. The pattern itself is the cause. The specific vulnerabilities just determine where the structure cracks first. Right now, the global financial system is deep into stage 3. Approaching stage 4, debt levels relative to productive capacity have blown past historical norms. Asset prices in multiple markets have risen faster than underlying income generation. Central banks have started withdrawing the support that kept borrowing costs artificially low for 15 years. The mathematics haven't changed. The pattern hasn't changed. Only the specific circumstances are different. The psychological element: people usually talk about financial crises in terms of technical factors, debt ratios, interest rate spreads, liquidity conditions. These things matter, sure, but they're not the primary force that turns market corrections into systemic collapses. The psychological dimension is what really drives it. During credit expansion and rising asset prices, market participants develop this confidence in their ability to predict what comes next. That confidence gets reinforced by successful near-term predictions. Investors who bought stocks or real estate in rising markets made profitable decisions. The returns seem to validate their analytical frameworks. This creates what researchers call an illusion of control. People believe they have skills that enable them to navigate markets successfully. In reality, they've just been riding a wave created by expanding credit and rising prices. The skill they're reattributing to themselves is mostly just being in the right place at the right time. This illusion becomes widespread during late-stage booms. It shows up as declarations that fundamental economic relationships have changed. The old metrics don't apply anymore. We're in a new era where traditional constraints have been overcome through technology or sophisticated financial engineering. Irving Fisher's permanently high plateau was exactly this psychology at work. He genuinely believed the American economy had reached a new equilibrium where stock prices accurately reflected corporate value and would stay elevated. His analysis was thorough and data-driven, and completely wrong. The data he was examining reflected temporary conditions, not permanent transformation. When prices start falling, the same psychology operates in reverse. The initial decline gets dismissed as just a correction, a healthy pullback within an overall upward trend. Investors who profited during the rise see declines as buying opportunities. This temporarily stabilizes prices, creating brief recoveries that seem to validate the assessment. Then the decline resumes. The pattern repeats: small recovery, further decline, small recovery, further decline. With each cycle, confidence erodes a little more. Eventually you hit a threshold where the majority of participants suddenly recognize this isn't a temporary correction. It's a structural breakdown. The shift from confidence to panic can happen remarkably fast. Market participants who are certain about the system's sustainability become equally certain about its imminent collapse. The pendulum swings from one extreme to the other without stopping in between. During the Weimar hyperinflation, you could see this psychological shift in how people treated currency. For months, Germans kept using marks despite accelerating inflation because admitting the currency was worthless was psychologically unbearable. Workers accepted payment in marks. Shops priced goods in marks. Banks held deposits in marks. The collective commitment to the fiction kept the fiction alive. Then, over just a few weeks in late 1923, the collective psychology flipped. People started refusing marks entirely. Barter became the main way to exchange goods. The currency that had retained some function through collective belief became completely worthless once that belief dissolved. There's this phenomenon called normalization bias that plays a huge role here. It's the tendency to underestimate how likely or severe negative events are. People assume that because a catastrophe hasn't happened recently, it won't happen in the future. The longer stability lasts, the stronger this bias gets. During the 1920s, the American economy had enjoyed nearly a decade of prosperity. People warning about excessive speculation or unsustainable credit expansion got dismissed as pessimists who didn't understand the new economic reality. When that small correction happened in March 1929 and quickly reversed, it reinforced the view that any disruption would be temporary and manageable. This bias prevents appropriate preparation. If you think a crisis is unlikely, why bother taking action to protect against it? This creates vulnerability when the crisis actually arrives. The lack of preparation then makes the crisis worse, which retroactively proves that the people warning about risk were right. But by then it's too late. The pattern keeps repeating because human psychology doesn't fundamentally change. Each generation thinks it's more sophisticated than the last. Each financial boom generates its own justifications for why this time is different. The specific rationale changes, but the underlying psychology stays the same. Right now, we're in the phase where warnings get dismissed. Market valuations exceeding historical norms are explained through narratives about technological transformation or unprecedented monetary policy tools. People suggesting the current structure might be unsustainable get labeled as permanently pessimistic, perpetually wrong, unable to adapt to changing times. This is always how it starts. The silent phase. There's a particular period in the development of financial instability that doesn't get enough attention. It's the time when everything looks fine on the surface. Official economic indicators show acceptable performance. Conventional wisdom says the concerns are overblown. This is the silent phase. During the silent phase, underlying imbalances keep building, but slowly enough that they don't trigger alarm bells. Debt levels rise gradually. Asset prices appreciate steadily. Credit spreads stay narrow. Volatility remains suppressed. Every month that passes without crisis reinforces the sense that crisis isn't coming. This phase can last for years. Throughout the 1920s, from 1922 to 1929, the American financial system was in a silent phase. Problems existed under the surface. Agricultural debt was unsustainable. European economies were struggling. Corporate earnings growth had started slowing. But these concerns took a back seat to the dominant narrative of prosperity and transformation. The Weimar Republic had its silent phase between late 1922 and mid-1923. Inflation was accelerating, but it hadn't hit the exponential phase yet. Prices doubled, then doubled again, but over months rather than days. People adapted their behavior incrementally. The catastrophic hyperinflation seemed unlikely to most observers. When it hit, it came fast. The 2008 financial crisis followed years of silent phase buildup. Household debt reached record levels. Mortgage lending standards deteriorated. Complex financial instruments were distributing risk in ways that obscured rather than reduced it. Various analysts published warnings. These warnings got acknowledged, discussed, then mostly ignored. The housing market was strong. Employment was solid. GDP kept growing. Until it didn't. Right now, the global financial system is in a silent phase. Debt has reached historically unprecedented levels, but this has unfolded over 15 years. Each year, debt increases without triggering crisis makes the next increase seem acceptable. Central banks have started tightening monetary policy, but gradually, with frequent pauses, allowing markets to adjust without dramatic disruption. The silent phase creates a false sense of security precisely because it's characterized by the absence of acute crisis. Investors and policymakers start believing the risks have been successfully managed. The very stability of the silent phase gets interpreted as evidence that warnings were overblown. This is actually the most dangerous period. The imbalances are at their largest during the silent phase. The potential energy stored in the system is maximal, but because nothing has broken yet, the perception of risk is minimal. Preparation seems unnecessary. Taking defensive positions looks overly cautious or even irrational. When the silent phase ends, it tends to end quickly. Some seemingly minor event, one that in hindsight appears totally insufficient to have caused major disruption, triggers a cascade. The event itself isn't the cause. It's just the catalyst that exposes fragilities that had been accumulating during the silent phase. In 1929, the specific trigger was ambiguous. Some pointed to tariff discussions. Others mentioned a speech by a financial expert warning about overvaluation. The real cause was that the mathematics had become unstable, and any catalyst would have worked. What mattered wasn't the spark, it was the conditions that made everything combustible. The silent phase isn't a period of safety, it's a period of maximum danger disguised as safety. The longer it persists, the larger the imbalances grow, and the more severe the eventual correction becomes. We're currently in the late stages of a silent phase. How much longer it'll last is impossible to know. What we can know is that silent phases always end. The mathematics guarantee it. The psychology ensures it. The historical pattern confirms it. Closing reflection: the people who lost fortunes in the 1929 crash weren't foolish. They weren't ignorant. They were responding rationally to the information available in their context. The experts declaring prices sustainable were acting in good faith based on their analysis. The institutions that facilitated the crisis were designed by competent professionals trying to improve economic efficiency. The failure wasn't about intelligence or competence. It was about pattern recognition. The same sequence is played out throughout recorded history. Real growth transitions into credit-fueled speculation. Asset prices rise beyond sustainable levels. Confidence hardens into certainty. Warnings get dismissed. The mathematics become unstable. A catalyst appears. Confidence collapses. The structure fails. This pattern exists independent of human intention. It emerges from the interaction between human psychology and financial architecture. As long as humans respond to incentives, as long as credit can expand, as long as assets get priced based on expected future returns, this pattern will keep recurring. The reforms implemented after 1929 did prevent 2008. The reforms after 2008 prevent the next crisis. They might change how it manifests, but they can't eliminate the pattern itself. Right now, global debt levels exceed anything we've seen in peacetime. Asset valuations in multiple markets are at or near historical extremes. Central banks are withdrawing the support that kept the system stable for 15 years. The mathematics are approaching an inflection point. The specific timing is unknowable. Financial systems can stay unstable for extended periods. This process might unfold over months or years, but the direction is set. In 1929, within just a few weeks, the collective perception shifted from permanently high plateau to catastrophic collapse. The change wasn't gradual. It was discontinuous. One day the system seemed sound. Shortly after, it obviously wasn't. The difference between those two states wasn't new information. It was the psychological shift from confidence to panic. That transition is binary. Either the system is perceived as sound, or it's not. There's no middle ground. The warnings issued before October 1929 were correct. The system was unsustainable. They got ignored because the system hadn't failed yet, and humans are wired to respond to immediate conditions rather than probabilistic future states. That tendency hasn't changed. The pattern hasn't changed. Only the specific circumstances have changed. In 1929, people didn't see the crash coming because they were surrounded by evidence that everything was fine, until it wasn't. History doesn't repeat exactly, but it rhymes with remarkable consistency. The question isn't whether the current structure is sustainable. The mathematics have already answered that. The question is how much longer the silent phase will last and what catalyst will mark its end. That answer will be obvious in retrospect. But by then, it'll be far too late to act.